This is Rod Kusin, Spooman for Risk. It is December 26th, 2011. The market has not opened for trading as of yet. However, we want to ask the $10,000 question, and that is, where is this market yet going this year, or perhaps into next year? Let's answer this question by way of looking at a couple of things off of the VIX. Now, where has the VIX been? Well, over the last couple of years, you notice that we had a low back in April of 2010. The market went up, came back down, went back up. Was that predictable? Well, let's take a look here. Let's run a Fibonacci extension. Oh, look at that. That high, roughly 100% extension from this low, was very predictable. And we see that that's exactly what did take place here. So what about the future? Where might we be going from here? Could we be coming right back down to this roughly 14, 15 number on the VIX? Well, take a look at this. From this pivot here down to here and back up to there, guess what? Takes us right down to around 15 on the VIX. Is that where we're going? Likely. I think so. Now, whether we're going to get there within the next few days, few weeks, remains to be seen. But it looks like we're headed right back down to that 14, 15 range that we were at back in April of this past year. Now let's look at a few other things here. Now this is a daily chart. Now you can see from the standpoint of the daily chart, over the last couple of years, the Z-score is getting very, very close to an extreme from the zero line. Z-score being a function of standard deviation. That's not terribly unusual, but we've seen it happen back in April of 2010, kind of touched that line late in the year, and then went back up, came back down in April, and is coming very close to that same general area of standard deviation again. So I would suspect it will get there. Now that doesn't necessarily mean that once it does, it's not going to go any lower, because we could easily have a divergence even though the Z-score is heading back up. Secondary point is the stochastic here. That's what we would refer to as being oversold. Really, this is more like an overbought condition because of the inverse relationship between the VIX and the Spoos. But let's take a look at the same data on a weekly basis. Now, when you look at this chart on a weekly basis, the Z-score isn't anywhere near the level where it has frequently turned. So we've got more room onto the downside, and the stochastic here really isn't in an oversold condition just yet, and it certainly hasn't turned to the opposite direction. So that too confirms that this is likely going to continue to move down somewhat. Let's look at this on a monthly basis. Now when you view the VIX on a monthly basis, now you see a much different situation. The VIX has only begun to turn from the standpoint of the stochastic. The standard deviation is by no means below zero. or for that matter, turning up. So here again, more reason to anticipate. There's room to the downside on the VIX, and of course that translates to a move to the upside on the Spoos. So long-term forecast here, and I don't mean exceptionally long. It may in fact be a more of a short-term forecast for the next few weeks, is that we do have more room for the VIX to drop and more room for the S&P 500 to move up. Now here's what we see on a daily chart of the Spoos. We're just beginning to see increasing volume since the last drop into 1200, and it would be premature for us to make any suggestions about how or where this is going to go immediately. But the tendency right now is that we've got increasing volume, which is further indicating a rise in the price of the Spoos, at least for the time being. Now this level up here, right around $1283.50, could very well be tested. Certainly this previous high at 1266, that will very quickly be tested, as we don't have too much room for that to go. But now notice that the probability is that by the time we reach 1266, the volume bars will in all probability be very divergent. Given that this is the last week of the trading year, volume generally does tend to decline, and so there's likely going to be a divergence there. Now that divergence could signal at least a temporary sell-off, and that sell-off could be rather steep. So let's draw some quick extensions from here to there, down to here approximately, and you can see a 100% extension, which I think is extremely unlikely, would place us well over the 1300 level, and as I say, I really seriously doubt that we're going to be moving that high anytime soon. But if we recalculate where our extensions could be, and it looks like we've already got better than a 61.8 extension here. Let's just verify that. Well, not quite. All right, we have a little bit more to go there, up to 1278. So that could be 1278, 1279. High probability there that we'll move up to that golden ratio. And then I think we could easily see or begin to see a more significant sell-off. So now with that having been said, just based on where we are right now, where do we see the downside? Well, from the high here, which was at 12, let's look at that again, 1283.50. If we were to go right up to that same area around 1278 to 1280, just looking at an extension down at 100% would take us right back under the 1200 level and even past 1150. Again, is that likely? I don't think that we could see that anytime soon. Not to say that it can't happen by any means. In all likelihood, eventually that we'll go back down there and test that level. But right at the moment, I don't see that in our forecast. I think we're going to see a sell-off. I think it's going to come fairly soon. And let me show you where our gap data is putting us. In fact, let's go ahead and just run some of the additional numbers here and see where some additional Fibonacci lines would put us. Let's look at the following lines. So there we have it around 1193, 1172, 1156. Do we have any gap data? Yes, we do. We placed our gap finder on our data and noticed that we have gaps at 1222, 1218, 1188, 1148. Let's just look at these two numbers, 1188 and 1148. That 1188 level puts us above the 76.4% extension, and the 88, 1148, that is, puts us below the 88.2 extension, making it more likely that we'll go all the way back to a 100% retracement. This, of course, that low being at 1141. So there is a significant reason to anticipate that the market will sell off, but I think it's still going to be a few days at least before we really begin to see the market begin to drop. And I would wait until we try to test that 1266 level before getting overly concerned. And that could easily happen tomorrow. So watch your indicators carefully, as the downside potential here on a daily basis could be pretty significant. We could get a very significant drop over the next over a several day period once we top out on this rally. So 1266 could be a very important number, just given the likely divergence that we're expected to see once that occurs. Let's throw our z-score on this data. Z-score has not begun to turn, and we still have very positive momentum on the move up, so that further confirms more of a move to the upside before we begin to head back down. So still we have some room in that regard. Now when we throw a stochastic on here, a fairly fast stochastic, this looks real interesting because once again, if we head back up to the 1266 level, just given the number of days that it might take for us to get there, which wouldn't be more than a day, in all probability, again, even the stochastic will show a divergence. And that kind of divergence tends to be compelling, causing the market to drop, at least from a technical standpoint. And, of course, the climate for a drop in the market at this time of year is pretty significant. So, just to summarize, what are we looking for? In the next few days, we're looking for a continued rally in the market and anticipated pivot back down below the 1200 level, perhaps taking it significantly down, even as far as an 88.2% retracement or below. When that will occur, that remains to be seen. We'll continue to watch our indicators to see what is developing, but I wouldn't be holding on to my money for very long here. All of the indicators would suggest that we're in for a correction. Think about that. If we run up to even 1280 and we come back below 1180, that's better than 100 points, 1,000 points on the Dow or better. So look for that. I think it's more than likely we're going to see that occur. Now, there's one other thing that we just want to mention before we let you go. You're not going to see this so much on a daily chart. But between 11:25 and 11:28, something significant happened. Let me show you what it is. Again, the time is 11:25 to 11:28. Now look at where the market closed on 11:25. It closed at 11:47.75, and then the following day opened at 11:66. Friends, that is a huge gap. That's a gap. We generally will not see a significant gap between the open of the current day and the close of the previous day, a gap that doesn't in some fashion get filled. But this gap did not get filled. So looking at it from the standpoint of our gap finder, this is what the market really looked like. Now here's the close on the 25th, and here's the open on the 27th. Big gap. Real big gap. And guess what? In my book, gaps are always filled. So just on the basis of the gap data, a retracement back down to 11:48, that needs to occur in my book. Now, maybe not in yours, but in my book, I say, oh yeah, that gap's got to get filled. So there's even more reason to anticipate a sell-off is in the making. We'll just have to see how far up it continues to move. There is more of an upside potential before this thing begins to reverse, but reverse is inevitable. And that's our market synopsis for the upcoming week, last week of the year 2011. Look for a little bit more on the upside, but keep in mind the downside is fairly significant and rather brutal. That being the case, watch your finances. We're in for a bumpy ride. This is Rod Kusin, Spooman for Risk.